Yeah.
Increase wages, maybe output prices go up.
So you'll be the only one with volume, all right? So
Theoretically, we some people. Work. The bank. So here's real money.
Yeah.
And we need all banking stuff. So cool it. And the bank into the.
So if your volume,
You don't
Want
want
me
to
to
do
put it
it.
there?
No, it's good.
no,
I went to Union Bank.
Right.
and did the
there's,
insurance.
pull that all the way up. Yeah, I know, so I need to change the background, because
with
it's,
Roger Smith. And
okay,
then
there
from
it is.
branches to
Turn it around.
Yeah, let's start a bank with this formula. In my opinion, anyway, we got out of there. Think we want to take down the road.
Yeah, that is weird. They were the bank.
Oh, no.
It's
The whole
recording.
premise was getting
Okay.
communication.
Ready? So you're on, we're on.
Yeah, we're
So
on.
whenever you're ready.
We're ready.
We can, and then just make sure we're recording.
Yeah, it's recording.
Perfect. All right. Chair, or is that?
We're ready, John. Who are we missing, John? Let's let John return. What was it, 463? Was that 10-year?
We ended it at 460.
460,
Very close. And I was just looking on Jan 1, it was 388.
Yeah.
And so I just think from the psychology of it, right? How many folks are locked into 5%, 10 years, and then they went to 388, now they're at 460. Do you jump in, or do you think they're gonna, it's just, that's why we have a market then, right?
Every trade's a discipline.
That's right, exactly. Even, the volatility rates. And you were just talking about the community banks, and I was just remembering a few articles from that. On the run on the bank, and then we put technology into it. You can run a bank in 30 seconds, you know, whatever the number is, and just amazing how all that played out. Yeah.
Internet speeds.
That's right.
That was.
Yeah,
Guy getting a haircut, bam, the bank's gone,
exactly. And
basically.
you know, it's not as if that problem has gone away. As long as the rates are high, it's going to as that same back in that year. Yeah.
I just think you have the politics and the policies and mismatch, right? I mean, why, in the sight of any volatility, why would you have a deposit account anywhere other than a bank that's on the too big to fail list? So now you have a self-fulfilling prophecy, right? And I think if the government's going to wake up and say, maybe we should have supported deposit insurance in some of the, I mean, because the flip side is, I always thought, you know, some guy who's got 2 restaurants, but, you know, from time to time has $251,000 checking account, telling him he's supposed to evaluate the creditworthiness of his local bank. That's nuts.
Yes, ma'am.
Oh, okay. Are we back on?
We're waiting for one here.
Any problems?
No, we're waiting for you. Now we're starting.
Oh, now I feel
All right, John, thank you for coming. Both Johns.
Thanks again for the opportunity, and I know this is our second, but maybe first sort of approach to how I'll manage our investment reviews, but it's really up to you also as we build our relationship. I'll look for direction on that. But generally, we'll start with an economic update, highlight a few things. Again, as we mentioned, we want to try to be very timely with you, especially with your agenda. And then tonight, I thought we would present a portfolio strategy discussion. And in the future, we'll do strategies every once in a while, but we'll also cover your investment report. So I've got a few screenshots in the strategy, but the idea with the strategy tonight is to follow up on our initial discussion to make sure that we're going forward with the approach that you all would like to move forward with. It's not a huge shift from what we were doing, but there are some changes, and we wanted to make sure we covered that and get some direction. You've been great at helping us. We did a capital analysis to talk about that, talk about portfolio strategy. So as we're talking about the economy, the first page that you'll have, and I know there are two, slide presentations that look similar, but this one is economic update on the front cover there. The first slide you see there is, gross domestic GDP. And as we were mentioning it a few moments ago, so GDP finished the year off, very much stronger than what was expected. GDP growth in that fourth quarter was 3.4%. The third quarter, you might recall, was 4.9%. In both of those quarters, with each successive reading, actually they increased the growth for those past two quarters. A couple of highlights just before we move on. Consumers made up 2.1% of the number in September, and then we made up 2.2% in December. So even though GDP was lower in that fourth quarter, that had really mostly to do with business investment was down by a percent, and that was the biggest difference. And that category is always interesting to me because generally the thought is that's low or contractionary. The thought is businesses are expecting us to slow down as consumers. But if we look at this chart and go back several quarters, the businesses, I think, missed that too. Oh, I'm sorry, June. I'm on slide 3. Gross domestic product. And I will mention that. So as we mentioned, the good news is as consumers, we continue to spend, and that's helping our economy grow. We make up a majority of our economy, as we know. And then I may have touched on this last time. Just one comment with regard to the economy, and that is the level of debt that we're taking on. Not only as consumers, but as we all know, the federal government, so there's a lot of debt. When we look at consumer debt, credit card debt's at 1.1 trillion. Each quarter where they measure that, it's hitting a new record. Auto debt is double what it was 10 years ago, which is kind of hard to believe. But if you've gone out and looked for a price of a car, it might not surprise you why auto debt is.
Recording in progress. Are you starting to see any crowding out?
So some of the environment and suggest that subprime market has
Right. Oh, well, maybe that's it. Yeah, because I can, I can see that people are talking.
Mr. Magic Number. I've added this green line, so January. To the number of people on here. So on the left-hand side. Weeks, if you recall, so. Sure. But the good news again, is higher rates. This is what we're looking about that. And so
Yes, why don't we just get this?
All right. So on this presentation, this is our portfolio strategy review. And again, as we make our presentations, please share with me and our team your thoughts on if there's certain information you'd like to see. I grabbed a couple of screenshots of the investment statement from our month end, and this is for month end of March 31st. And so as we've come on board, the city's had a strategy of a 1 to 3 year strategy, as you know, and that generally comes with about a 1.8 year average maturity or duration. The current duration, as we can see down here, is right around 1.57 years. That's just a function of us coming on board and going through the onboarding process and getting a good handle on your cash flows. And then in preparation for our discussion tonight, you can see the balance of the portfolio in the market value. And then we've got a couple of other statistics that we'll discuss over time as well. But a couple of them, primarily we'll cover duration and then book yield and market yield. And of course, book yield is that measure of income that you're earning. And then market yield simply tells us what the current market would be paying for the portfolio of securities that you're holding. And not a surprise, it's very common for fixed income portfolios right now. And that is where the book yield's lower, but hopefully moving its way up towards the market yield as those securities are being reinvested at these higher rates. And so with this reinvestment strategy that we'll move forward with, whether we maintain the 1 to 3 or go with the 1 to 5, we'll expect to see that book yield move up. And that'll be a good thing, especially as we mentioned with these rates having moved up. So just a couple of notes from the portfolio structure. So we can see here how a majority of the portfolio is between the 1 to 2 and 2 to 3 year areas, and that is by design. This portfolio has a number of asset backs and mortgage backed securities in there. And so when interest rates move, of course, it impacts a bit the maturity of those as what we call the prepay speed or the faster or slower that those pools might be paid down, whether they're auto loans or mortgages or so forth. But then we've also had some securities that move closer to maturity. So we can see here we have just over 10% less than a year. And generally speaking, whether it's a 1 to 3 or 1 to 5 year, our strategy when we're rebalancing would be to take securities that are drifting lower than 1 year and start and move them out on the curve. And we generally do that, usually each month, 4 to 6 weeks, just part of the rebalancing strategy. And this portfolio, again, has an opportunity to do that. And whether we move those into this 1 to 3 year or start to build out to 5 years, of course, what we'll talk about tonight. And then the other highlight I wanted to just draw our attention to as we move forward with the portfolio is this is not to be critical of the any prior managers or anything, but just to give you an idea of our thoughts and where we would like the portfolio to be here in the near term. And when we're rebalancing, just please keep in mind, we're not looking to go out and sell a bunch of the portfolio immediately, but this is part of our rebalancing. And one of those would be, if we look at your asset backs and your corporate notes, they represent around 41% of the portfolio. I've got a slide in here I'll show as we get to the end, but it just talks about how yield spreads between corporate notes and treasuries are actually pretty narrow. And so because those credit spreads are very tight, our portfolio team would prefer to have a lower allocation in those two particular sectors. And then when the spreads widen, that's when we would rather be back into those sectors. And so, by the way, those are things that we'll talk with you about when we meet. We'll talk about specific trades that we do and why we did those and the duration and really get into those specifics. So that was really our highlight on there, was a credit. The other thing that we would recommend with your portfolio, whether it's a 1 to 3 or 1 to 5, is, and we talked about this last time, is using a benchmark that has government and credit as part of the allocation of the benchmark. We think that's a better balance, and that can work for you or against you, by the way, depending on how that sector performs. And so in our view, it's better to have one. It's not going to ever be perfectly matched, but at least you have similar sectors in your benchmark to the portfolio themselves. And so that would be our recommendation, is to use what we call a government credit benchmark. It's an industry standard. It's an ICE B of A index that we would recommend.
Can you remind us what was in the Morgan Stanley index that that was being managed against, right? Was it a Morgan Stanley index?
If it was, I'm not familiar with that. I thought they were using just a 100% treasury index. Were they using potentially a Morgan Stanley? If they were, I can look into that. I'm not sure what that was.
Okay.
Okay.
But if it's all governments, we shouldn't use all governments.
Not in a 41% corporate holding portfolio. That would be, because even when you're looking at a government credit, it's not going to have 41% in corporate notes in there. And
We get some free credits.
you get some good, right. Although you're not really getting paid for it right now,
Okay.
in our view. So that will, and we'll summarize this and bring, and document that as we finish, as we wrap up tonight and determine the appropriate way to move forward. So those are just a couple of highlights from the portfolio strategy. Again, do we want to stay with a 1 to 3? That's very common. And then a 1 to 5 year strategy is also common as well. And so that kind of ties into this next slide, June, if you wouldn't mind, on the cash flow. Our next one here. Thank you, June. June provided me some historical general fund balances, as we talked about last time, where we wanted to help you, not just with the portfolio we're managing, but overall. And we're going to work with June's successor as well, and develop we met with June just a few weeks ago when we talked about creating like a 1-page dashboard for you and for the city that it'll show the holdings of your portfolio, but it also show any bank balances or LGIP balances. That way you have a snapshot in one single slide. So that's something we'll be working with you, or working with the city to develop, and we'll present to you as well. So this just is some data back to January of 21. Your general fund, just month-end balances. And what this cash flow analysis does is it really just looks at those balances and what are the low points over the time frame that we're looking at. And I just highlighted last June and then March of this year, very similar. So what our model does is it looks at those minimum balances, and then we can allocate a certain percentage of what we calculate as your core portfolio, and we move that into the liquidity portfolio. We call that the cushion. And the reason is just for an extra level of safety. So this model, we've got 10% in that cushion. We can adjust that. But if you factor in a 10% cushion and then look at these balances going back to January of 21, right now the model is estimating a core portfolio of around 57 million. And your portfolio is right on pretty much on target with that. So that's a good thing. And we were talking with June about whether or not there were any major expenditures that would come from these funds. I don't believe that there are any anticipated now. And June, did you clarify that you haven't needed any funds from this? No. That's important for us. And as we work with you over time, if there does come to a point where there's a major purchase of some sort, or you need some funds out of the portfolio, that's where we can work with you and manage that. But we don't want to let too much be short. That's what your liquidity funds are for. And so that's finding that balance. So wanted to show the commission what your cash flows look like. And again, just reaffirm with you, your portfolio is really on target with what our model estimates is what you have for core or longer term reserves or longer term expenses. And that leads us to our conversation on 1 to 3 versus 1 to 5 year. And I've got performance on the next page. It's from last September, but we update that periodically, but it shows the similar trend that we're used to seeing. This again is your portfolio maturity that we saw from your statement in March. And this just gives you an idea of a sample 1 to 5 year portfolio maturity. And percentages might be, of course, different from portfolio, but they're going to be generally the same. And what we usually see is around 2/3 of the portfolio in that 1 to 3 year area. And then in this case, right around 1/3 or so in that 3 to 5 year area. And the idea again is to, if they're core and you don't anticipate needing these funds, to potentially earn a higher rate of return over time, but you will have more volatility on a 1 to 5 than you do a 1 to 3 because you're going from 1.8 years out to 2.6 years. And so we wanted to show you what that looks like, what that maturity structure looks like, and then. Yeah, sure. Thank you. That's what I'm gonna show you on this next slide. And it does change, but that's exactly what are we gonna get paid to go out from 1 to 3 to 1 to 5. If you don't mind, we'll jump over to that next slide. That'll show us the history. So again, we generally update this a couple of times a year. It's time to update it for March 31, but these trends are very similar over time. And so if we go from the left side to the right side, we're going really just extending the duration. And we're showing a 15 in the dark gray, 20-year returns in the light gray, and then 25-year returns in the bluish color. And so what we can see is as we go from a 6-month to a 1 to 3 to a 1 to 5, and then even out to a 3 to 5 year, which is just really for context. Very rarely do folks use that one. But the 1 to 3 and 1 to 5, of course, are most common. And so if I got my math right, if we went from a 1 to 3 to a 1 to 5 for the last 20 years, it's about 24 basis points on an annualized basis. And then if we go out to 25 years, it's 26 basis points. 15 years, it's 29 basis. So anywhere from 24 to 29 basis points, but that's on an annual basis. That's not over those longer time frames. And 25 basis points could be meaningful for your size portfolio, but it does come with more volatility risk. And that's what's very important for us to communicate and make sure that the decision to be comfortable with that volatility for the additional return. But this is what it looks like, Mr. Chair. So,
So can I throw the first rock on this one? So 24 basis points on $50 million, we're chasing $120,000. And I guess, why would I chase that in a curve right now that makes no sense at all? In other words, the premium for going out right now is actually negative. It's all a bet that the short end comes down, the far end stays there. It's not what happened right now. And I guess I understand the 15, 20, and 25 year look back. And I have a related question for Gabe on that, but just doesn't feel like there's any compensation now for going out and taking duration among a pretty thin-skinned group who don't have much appetite for volatility, criticism for volatility. And if I had like a super sweet upward sloping curve and you said there's 50 basis points for free, just go get it, and this is kind of normal, and as long as you can hold to maturity, it'll all be cool, maybe I'd do that. But you're asking me you're not asking me to do this. We would reduce current yield in the whole, you're right, that the whole curve comes down and restores slope while we hold the security.
You're right on target. And that's why when we're talking about this, that's why I wanted to show you historical information and this helps us to understand your perspective and what you're comfortable with doing. As I mentioned, that 1 to 3 year strategy is very common. We manage mostly 1 to 3s, but we do manage a lot of 1 to 5 years. So as part of our initial conversations, I wanted to share this with you and show you these couple of different options for you. Absolutely. If it's in the other.
There's a second question, which I think goes to you, which is, he's basically saying, which all comports post community center,
that the right way to think of this money is there's about $50 million that's really a baseline balance, a little more than that, that hasn't been invaded for a long time. And the second thing you do by taking duration is you're really making a decision, I'm not gonna invade any of that, because then instead of holding the maturity and you have to step up and you have to take your mark to market. Instead of mark to marking it in this cute little line that says we're $1.1 million behind, in fact, the cash leaves the door. And so the second question is, what's really the baseline amount of money that we never consciously spend into? But then I'm gonna stop talking, because I don't wanna push against your advice. It just feels like, and it's a conversation to keep having in a normalized world. It just feels like giving up yield to buy duration right now in a curve that makes no sense feels not really on top of my to-do list, but I'll see everybody else in the
The
commission.
risk reward ratio doesn't seem good. 120,000, especially, the Wall Street Journal reported that the last treasury auction on Friday was not well received. So if we're accumulating debt at such a rate and we end up in a situation where there is crowding out, having long-term bonds is not gonna be where we want to be for 125.
Yeah, 5 years, not really long-term bonds, but we're gonna run into.
Well, 5 years is longer.
But everybody ought to. Why don't you finish up and then ask us, then we'll form a consensus. That was just, I just want to make sure I understood the math.
And I appreciate the discussion. That's why I wanted to have this. The first step was the cash flows.
Yeah.
And that's a great story. You're right on target with that. So then, the thought was, okay, well, let's just share with you what these options are. And I certainly respect this discussion, and we want to manage it the way that it meets your risk tolerances and goals. And so thank you for the discussion to help us with that.
John, so you showed that there's currently built an expectation of 2 rate cuts this year. Suppose that expectation moves to, say, 1 or 0 rate cut this year. Which bet would be more beneficial, 1 to 3 or 1 to 5? Or is there a relationship there?
See, and that's the challenge and to the conversation. It's so, we talk rate cuts, which is on the short part of the curve. Some of the conversation we'll get, and not necessarily with this strategy, but if someone's majority liquid right now and well, why would I go out on the curve? I'll wait until rates go down. Well, generally when that happens, and we don't know, but when short-term rates go down, longer-term rates generally follow, maybe not as much as short-term rates. So you miss out on capturing the current 2, 3, 5 year rates. So when it comes to the question of more rate cuts, that is, I don't have an answer, because the longer term rates are so dependent on some of these other factors that we don't see right now. If you had 2 rate cuts, which.
Well, if your belief, if somebody's belief is that there'll be fewer rate cuts than
Yes.
the market is expecting.
If we're expecting fewer rate cuts, then your shorter term funds are going to continue to outperform. Absolutely. And that's what we've seen. We're back to one of my original comments, the length of this inverted yield curve. If you knew as an investor, well, we probably wouldn't be sitting in this room, but if we knew 18 months ago that this curve would be inverted for 18 months, you'd leave it all short and then wait till, so, yeah, if it's.
Yeah, I gotta leave and make some trades now, but I know.
So, if they don't, so the other side of that is.
Reinvestment risk, right?
That's exactly right. But if we keep seeing the flattening of the curve, maybe we actually get to a positive sloping curve without them even cutting rates. That would be somewhat amazing to me. If the thought of if inflation keeps going up, John mentioned the crowding out. I don't know if I clearly answered that, but with the 7.4 trillion coming due, the $2 trillion deficit, we've all read where foreign countries, China in particular, doesn't have the appetite they used to have. There are a lot of factors coming into play that could likely keep rates higher just due to the excess supply in treasuries in particular. And that could push those longer term rates up. So it'll be interesting to see how that plays part of it.
Yeah, nobody knows.
That's right. And so just like I mentioned with the Fed funds rate, we will not be managing your portfolio guessing which rate. We want to make sure that we get to the duration that you're comfortable with and then manage to that duration. And hearing a couple of the comments, so I did want to make sure we talked tonight with these portfolios, do you want a buy and hold strategy, or do you want, I believe PFM was managing and reinvesting and rebalancing, which is what I was referring to earlier, but we want to make sure, because if we're rebalancing, we'll be selling sometimes at a loss, and then in a downward trending market, you'll be selling at a gains. Historically, those generally they'll balance each other out, and most of your return comes from the income of the portfolio. But if you prefer a buy and hold, we manage buy and hold as well, and we can still over time build out the same average maturity or duration, but that's an important point that we want to make sure, because we don't want to start trading if your idea is for us to, let's wait for securities to mature and then ladder those out, so.
Which do you recommend?
It goes to your tolerance. We like an actively managed portfolio because we're not trying to time the market. We're taking what the market's giving us, but it really ties back to this and finding that duration that you're comfortable with and volatility, and then managing to that over time. As I mentioned, if you look at it in rising interest rate environment, now, of course, we're in a historical rising rate environment that we've not seen. But, even when you go through rising and declining, if you're selling at a loss in a rising interest rate, but you're capturing the higher interest rate now, and then when rates decline, you'll sell and you'll buy lower interest rates, but you'll take the gain. And that's where generally those balance each other out. And really it's the income from the coupons through the life of the portfolio. If you look at the total return, it's 85 to 90+% is from coupons of the portfolio. But we want to make sure that you're comfortable. We have clients that are comfortable with that active management, and others that just don't want to see any realized losses. But then you won't see realized gains either, because they'll mature. But you can still ladder it out and have a target duration that you decide. You're just reinvesting when it matures at whatever the market is that day. Whereas, here's an example. If Apple comes to market, and we like the spread on that Apple note, if it's a buy and hold strategy, you generally will miss out on that. Right. So you can capture, outside of treasuries, corporate notes, municipals, and so forth, you have the opportunity to do that with an actively managed portfolio that you generally will miss out on a passive strategy.
You run in markets where transactional friction is very low.
Right.
What's the cost structure between the two ways of managing
For us?
Our costs,
So
portfolio costs?
So our fees are based on the assets under management. We don't make fees on trades. Oh, absolutely, yeah, right. That came up last, yeah, great question. So that's the same.
So 1 year strategy, 5 year strategy, because there's more trading going on with more active thing, there won't be any increased cost for us.
No. In fact, I believe you get more of our resources from an active managed strategy. You've got a credit team that analyzes all these issues outside of treasuries. You've got portfolio managers that are looking at this every day, and when they see these opportunities come to market, they capture those for our portfolios. So, I do believe you'll get more resources from us, but we want to make sure it's a strategy that's right for you.
The transaction costs are not significant.
The transaction costs from our perspective are zero. The broker is going to make a fee. But the nice thing, I will tell you, and not just public trust, but any large investment manager, a broker would rather sell to a large investment manager a 10 to 20+ million dollar block than sell $21 million blocks. So you generally can get favorable pricing. And of course, we bid your securities whenever possible. There might be if an issue comes to market and there's only one broker, but we're looking at that versus market. But we're looking for optimal pricing for all of your transactions.
Is there any data about your performance, active management versus passive management?
So we can show you our performance versus the benchmarks over time. But it's really difficult it's not impossible to compare one portfolio to the other, because you'd have to start at the same time, have the same strategies in place, and compare those. But we do, as an investment firm, we're what we're called GIPS compliant. So our performance measures are reviewed and approved by Dr. Ernie does GIPS compliance, what that tells you, the city, and all of our clients and prospects, is that the way we calculate our performance is done to industry standards.
Is there any analysis that would show, in the long run, because nobody knows what's going to happen, what portfolio performs better, of 1 to 3 or 1 to 5?
So that's where you look at these total return numbers. This would be the chart that tells you that. And then the question is, and by the way, and as Tony mentioned, the spreads are very narrow. And a lot of that is due to this inverted yield curve. Now, if rates go down precipitously, you're going to have significant unrealized gains in these longer term portfolios, especially. And so you could see the spreads being significantly wider, but you would only recognize those if you were in that spread. But what I'm hearing from this commission is these spreads are narrow. We like our 1 to 3 year. And so my
A lot of
recommendation,
weigh in, which is good.
I'm sorry?
There'd be a lot of weigh in, just,
Yeah, absolutely.
I have a strong man, but everybody ought to convey that, unless you want a straw man to shoot at.
I think that was your question. And so right now, you know, you're 25 basis points from a 1 to 3 to 1 to 5 on an annualized basis. And we
don't know what that will be next year. And what I'm trying to understand is that in the long run, from a portfolio, you know, what's the highest, I mean, what's more likely for the highest
Yeah,
return?
but I think we're in flipping that data. That data tells you that if you did this for a really long time, that's what you squeeze out of it, 20, 30 basis points, okay? The incremental amount you would get today is negative because the curve is downward sloping. And you're basically buying the notion that I'll go out, rates will come down enough and I'll have locked in. Capital loss, mark to market, right?
Your guess is as good as mine as whether that's gonna happen.
If you're gonna win.
Yeah, I think that, I don't know, I mean, my take is that thinking in the long term of interest rate environments that go up and down, you know, that maybe a 5 year, even though today is only maybe 126K difference, that's 126K we don't have, right? And
person.
yeah, exactly, pay for another finance person.
Yeah, you know, today it's negative, right? You will spend money currently in order to extend duration. So you will have less income.
Not the right time to go in.
So if we were to stand here today and we were just looking at that yield curve chart, but it's in your economic update, and if we bought a 1 year security at 5.15, or we bought a 5 year at 4.62, the question would be, what could you reinvest that 1 year at a year from now, right? And then a year after that. That's that analysis. And to your point, we don't know what that would be. The nice thing though is you're utilizing a diversified approach already because you have liquidity funds that capturing these higher rates on the front end. And then you have your core portfolio that's laddering out, in this case, between 1 to 3 years. So you're not putting all your eggs in one basket, which we would recommend you not do, because when rates go down, we don't know how fast they'll go down or how long they'll stay. I mean, if we look back, when I look at these historical charts, it's scary sometimes, but if you remember, we were at 0 rates from 2009 to 2015, and they were at 0 rates from 2020 to 2022. So 9 years out of 14, 15 years, we were at 0 interest rates in your overnight funds. Now, hopefully they won't need to push rates down to 0, but at some point they'll likely have to push rates down. That's where your core portfolio is going to start to outperform again. And so the fact that you're using both helps you in both a rising and then a declining rate environment in our view. So I'm
gonna give the commission a straw man, so everybody can shoot at it. I personally, I'd stay the course at 1 to 3. I'd like you guys to propose an index that makes sense, and we hired you guys to manage to beat that index by a little bit, and if you find credit spread or duration, I don't care which it is, you can go see if you can beat it by a bit, but it strikes me as not such a large amount of money. I don't have such a great amount of clarity of what you guys want to spend on a go-forward basis. And it just seems like a creepy market that I'm a little bit in the do nothing, but we ought to have a legit index to hold you to, and we ought to tell you guys to go manage 2 or above it. But that's just, you know, probably more opinions than
without taking on more risk than is inherent in the index.
which is, you know, about 185 on duration, something like that. That's what those run. Help me, John.
Duration's 1.8 years is a target, and based on our initial meeting, you strike me as you've got some technical, background in this, so I added one more slide. And I won't be too, but it really ties into this credit and where we feel it is, and these are things that we hope you'll find, again, where we can add value, and this is an analysis that actually Mark, your portfolio manager, and I work on. At the top is really just showing, there's a lot of data. I'm not gonna get into all of it, but in the yellow box, you see that 53 there. That's the overall spread of US corporates as of March 1st. So, right, just a little over a month ago. And then for asset backs, it was 62 basis points. If we look down and we look at corporate notes for the last year, average was 70 basis points. So when we're talking about narrow spreads, we've seen the last year spreads were on average 70. As of March 1st, they were 53. It's a pretty significant narrowing. And then on the asset backs, they were 62, and on average, they were 83 for the last year. And then it just goes 2, 3, and after 5 years. And you can see that trend. They start to compress a bit when you get to 3 and 5 years. But this is the kind of data and analysis that our team uses when we're looking at, wanted to share that with you. It's not just, hey, Apple's 20 basis points more than a treasury. Well, what does that mean? Is that enough? And we're gonna have to take what the market gives us, of course, and we want the name, and we know that Apple's gonna trade narrower than some other names because it's Apple. But these are the types of analysis that the team uses, and this is why when we're talking strategy, when we're looking at your 1 to 3 year strategy, we will, again, next time I show up, it's not like you'll have half the number of corporates and asset backs, but we'll start to move out of those and start to build out your treasuries. And then again, when we see some opportunities, whether it's back into corporates or potentially municipal bonds that come to market. And again, I won't be repetitive, but these are the things that we'll be sure to communicate with you, and I'll look to you for direction as well on anything else you want to hear from us when we're presenting to you on these portfolio strategy, on the portfolio strategy.
If you're looking to be the straw man, I'm with you, not against you. I wouldn't fight that. I don't see any compelling reason to take a step away. I mean, show me the next card first.
I think you're telling us we're in the middle of the fairway for smallish governments for whom this money is, really the nest egg in case something bad happens.
Yes, sir, absolutely. Absolutely. We recommend this strategy all the time. And I hope I didn't suggest that you move. I just wanted you to see that based on our conversation, what that would look like, what the returns look like. And then you make a recommendation, but as your investment advisor, I think you want me to make a recommendation to you all, and I can wait.
Reading the room, yeah.
Yes. So.
No, it's wise to make the recommendation. I also agree with Tony. I agree with this strong man. I think there's too much uncertainty to go that much farther out. And there's not enough reward.
Here's the other thing that I really love about our strategy is we'll have these conversations whenever we meet. And if at some point down the road you change and your goals or objectives change, we can it's not as if we're here and we can never change it. That's the beauty of having this dynamic program and having these conversations.
Well, ideas and suggestions are always welcome.
And we're gonna agree on an index, whether it's the ICE 1 to 4, whatever it is that you guys are gonna show how the portfolio did relative to the index, right?
So we would recommend, based on this conversation in the 1 to 3, that we utilize the ICE B of A 1 to 3 year government credit benchmark. And again, it's a Bloomberg, it's an industry benchmark that most 1 to 3 year portfolios in the public space use that have corporate allocation. And next time we meet, I don't know if the portfolio will be structured. We want to be in compliance with our GIP standards and all of that. We need to have the portfolio in the right structure before we can start managing it against the benchmark. But what I'll do next time we meet is bring that benchmark in, and so you can see that and talk it through about your portfolio and the benchmark. And then yes, we'll have total return performance versus the benchmark.
Any alternative views? Any reluctant participants who want to say something?
Nicely.
I think I agree with the 1 to 3 year duration for now, so.
I really like the analysis and I think we should monitor it, but I think at this point of time, 1 to 3 years seems right.
At some point, I would like to hear more about your active management and why you think you may have an upper hand over rest of the market participants in pricing something.
So with that, I guess that's a question I need to make sure I answer. Would you like us to, so we're gonna be actively managing the portfolio. I just wanna make sure we're good.
I mean, you guys should act, I think my view is, been hired to do it, it's an index you ought to beat. And we'll hold you to beat it, meet it or beat it, and you ought to have the tools to go do it. And I think our investment policy prevents you from, going to Vegas and putting it on red anyway, so.
And just to
Investment grade stuff or government credits, and it's just a matter of finding a little spread here and there or leaning into duration a little bit.
Great point. Just two comments. One, just as a reminder, we only manage public funds just like this as a firm. So everything is there similar to this strategy. And then when it comes to the benchmark, yes, our goal is to beat the benchmark, meet the benchmark. But I hope there's not an expectation we're going to blow this benchmark out, because if that's happening, then we're likely taking on risks that you have not asked us to take on. So that's the other side of that. But we'll definitely, and then on the active management strategy, that's where when we talk about the trades that we do, we will be specific on the trades that we made and why we made those trades and how they fit in. So we'll be sure to cover that. Yes. Thank you. I appreciate it. Looking forward to the partnership. Thank you.
Yeah, very good. What's the next agenda?
Will be the pre-meeting for meet our new audit firms from Badawi and Associates, and I think they are online.
Hi, good evening.
Could you please introduce yourself as our auditor?
Sure. So may I introduce myself? Sorry, I can't hear very clearly. My name is Mitesh Desai. I'm an audit partner with Badawi and Associates. I'm not the audit partner on the engagement. Ahmed Badawi is the audit partner on the engagement, but he couldn't make this meeting. Also on the call, I have Saleh Yassin. He's the audit manager, who will be conducting the city's audit. We have a short presentation just covering our audit approach. If you have any items that you'd like us to include in the audit, and there's some required communications we need to make as part of the audit.
That sounds great.
Right. If you could let me share my screen, I could probably.
User.
Go ahead and try.
All right, you should be seeing the presentation now. Right, so I'm just going to cover the engagement team, the deliverables, and scope of the audit. If you have any input that we should consider as part of the audit, required communications, some of the new accounting standards that will be implemented this year and the following year. And then if you have any questions or anything you'd like to discuss, we're happy to go over those. In terms of the engagement team, so as mentioned, Ahmed Badawi is the engagement partner. I will be the engagement quality control reviewer. We have an IT specialist, Omar Rahman, who will be looking at the city's ERP system and other sub-ledger systems that can capture information and kind of rolls into the financial statements. Saleh Yassin is the audit manager. Where audit senior is Samantha Michelle, she's CPA. And then we expect to have 2 professional staff assisting with the audit. if we need more, we'll assign somebody else as well. In terms of deliverables, so we'll be issuing our auditor's report on the city's basic financial statements. We'll be performing also the compliance audit for the Transportation Development Act. And also with the financial audit, it will be performed in accordance with Yellow Book. Yellow Book is governmental auditing standards. And that requires us to also issue a report on internal control of financial reporting and on compliance and other matters. If the city is required to go and have a single audit, which is an audit of federal programs, that's when your federal expenditures exceed 750,000, which a lot of agencies have now had to conduct this audit mainly because of ARPA funding. So if that's the case, we'll be also issuing a report on compliance over federal programs and also internal control over compliance. We'll be issuing a report on your GAN limit, and we'll also be issuing communications to the city council. It just includes our findings from the audit. Findings just meaning if we had any disagreements with management, if we what were the significant items that were considered as part of the audit. In terms of input, this is just something we always like to ask, or things that we need to consider as part of the audit. These are just some brain joggers here. It's just something that includes, whether the cities believe the city's governance structure is fine. If you have any concerns about how the management, any issues with city objectives, strategies, or any other business risks that you feel may impact the city or risks the city. And then also anything else that you may consider a significant transaction or significant activity that the city goes through. If you have any significant communications with the regulators, like the State Water Agency or for other grantors, if there have been any issues that we need to, any reports from the grand jury, and anything you'd like in terms of the financial statements, I'd like to hear that. And if you don't have anything anything at the moment, you can always email us if you have any other items you'd like us to consider.
I mean, speaking for the group of you here, I think we are thrilled to have you on the property, if you will, and look forward to having a firm in. Not that we had any disappointments, disagreements, or issues with the prior firm, but it's useful to have a new firm come on to the property. And if nothing else, you should expect, given that it's a relatively small city, and as you know, we have some turnover, that we trust that you'll look at ICFR carefully, and to the extent you have recommendations around ICFR, you'll bring that back in the normal process of completing your audit.
Yes, thank you. I think turnover is something that we're seeing that a lot of agencies are faced with. So we're quite experienced with addressing that. And with that, I understand that there will be flexibility or any assistance that we can provide in terms of assisting with, recommendations of policies and procedures. I think that's a common issue with turnover, is when there aren't really any written policies and procedures over significant accounting areas, and then you have a new person taking over without a lot of, when you have an immediate resignation, there are a lot of challenges in terms of figuring out what needs to be done, how it needs to be done, and so forth. So that's definitely something that we'll be looking at. And just the first year of the audit, it's definitely a lot of learning that we do. We look at a lot of agreements, do lengthier interviews with staff to understand the processes, and And also if we have any recommendations on the financial statements, those will be brought up during the planning phase of the audit.
Separation of duties, making sure that we have the appropriate separation of duties. It's nice that you have an IT person on your background. And if you guys can actually verify backups are being made and that they are recoverable.
Great. Yeah, I mean, we generally ask, having an IT specialist is definitely a great help. They definitely have a lot more questions and insights than we do as the auditors, as CPAs. That's not our primary objective. We do have some understanding of IT and the risks of IT, but our IT specialist has brought up issues in the past, last year, that a lot of our clients were kind of impressed by. So yeah, we'll be covering backups, general controls, anything, access controls, cybersecurity, and those types of items.
Also, how long it takes us to pay large bills and for contractors. What is our average pay date?
So I would make one point. I don't know if it's as much to the auditor as it is to you, Dave, but it's more based on my personal experience. But in those moments of transition, obviously their natural contact is going to be the interim managers. We know nothing about the city. And so you might want to use this as an opportunity to have a regular interactions with them, because they're brand new, they're discovering you, there's a transition, and that becomes as good as any source of validation for you of what's really working and what's not. So it's less about the audit, but more about a free outsider inside look, if you wish.
That's really good advice. I will take them up on that if they will allow it.
Sounds good. Next is we're going to cover some required communications as the auditors. So this is just a slide summarizing our responsibilities as the auditors, and then also management's responsibilities. It does become a bit gray, and sometimes there's a lot of misunderstanding when we assist management in preparing the financial statements, because at the end of the day, the final published document comes out of our office. But in reality, it's only our opinion that's our document. The financial statements are management's document. They take ownership of it and review it when they sign a representation letter. So our responsibilities are to evaluate internal controls of financial reporting, evaluate compliance with laws and regulations, review the financial statements and communicate the results of the audit to the City Council. Management are responsible for those financial statements, establishing internal controls, providing us with all information for the audit, looking at internal controls of fraud, informing us if there was any instances of fraud or suspected fraud, complying with laws and regulations, and then of course taking action on any audit findings we may have. Our responsibility also includes independence. So independence is very important to us as the auditors. We avoid doing any activities or any tasks that may impair our independence. We follow rules that are set by the AICPA and the State Board of Accountancy. So items such as preparing journal entries without management's approval, acting as management, making decisions, financial decisions, those are all kind of activities we're not allowed to do in addition to other things. We also have independence checklists that we pass around to all our staff with our list of employees and require them to let us know if they do have any potential conflicts. In terms of timing, so this is still being confirmed, but we expect our interim to be done somewhere in May. So we're hoping to start on May 6th, but if not, it will be probably shortly thereafter. And our year-end work will be performed in October with the objective of issuing the financial statements, in December to meet the reporting deadline. And of course, if there's any presentation required to council, that'll be done either in December or in January. Some of our clients have started pushing that meeting to January because just to avoid a lot of stress. And then also there's also, I guess, not that much eagerness to have a meeting at the end of the year. In terms of new accounting standards to be implemented, so luckily at the moment, there are only 3. Usually there's quite a lengthy list, and I'm sure GASB is planning to issue more, but Statement 100 is not probably going to have an impact to the city exactly. It's mainly a clarification standard on how to report corrections to prior years, and then also what qualifies as a prior year adjustment versus something that you would just correct in the current year, and also how those would be disclosed and presented on the financial statements. So if the city does have a restatement, if we find an error that relates to the prior year, for example, we would be following GASB Statement 100 in disclosing that. And then in next year, you have compensated absences, that's your vacation and similar types of leave. How those are measured and recorded and disclosed will be changing slightly. So for example, one thing that would be of impact is previously you were not required to consider related pays such as benefits, taxes, any other types of pays that you make as the employer in addition to salaries when an employee cashes out their leave. So with GASB 101, you do have to estimate or consider, that additional liability that you'll be paying out when someone takes their leave or cashes out their leave. And then statement number 102 addresses certain risk disclosures. So that requires us to disclose more information about potential risks that have come up subsequent to the year, I guess, subsequent to the year end date, or anything that we've identified during the year, those will be disclosed. And I think that's essentially it. If we have any questions, I have Ahmed's email address here just because he's the engagement partner, but you can also reach out to Saleh Yassin, who's the audit manager, if you have any questions or comments, or if you have any concerns that you'd like to share with us privately. That's something we're always willing to hear from anyone in the organization. And I think that's all I have, but I'm happy to answer any questions or hear more concerns that you'd like us to consider as part of the audit.
Can we get a copy of that presentation sent to us?
Yes, I can send it to June.
Great. Any other questions?
Perfect. Welcome. Thank you for getting involved, and the city manager has assured me his fullest cooperation because he enjoys audits, and we look forward to receiving your report and commentary later in the year.
No, thank you very much, and look forward to working with the city the coming year.
Great, thank you.
All right, thank you.
All right, now we passed on Tyler, and now a section for you to talk about succession in your finance function, and you can call it.
So, we are very sad to be losing Jamie. It will probably not be a surprise that we're replacing her with 2 people in a firm, so we can keep the output the same. That's what it's been. We contracted with Stephanie Bouchain Consulting. She's the principal in that consulting company. They provide finance and HR assistance. We happened to space on assignment that Stephanie was the one in her firm available. She's got a background in public finance. She was from Millbrae, the city of Rio Dell. She's a former finance director, former deputy city manager. She founded her own firm, I believe, about 5 years ago. and is probably, best known for the work she did in Manteca, when she served as our interim for quite a while. We also, we have her running, finance operations. We hired, Serena Reviar. I may not be pronouncing her last name correctly. Many people will remember her. She worked here for a long time. I was so close. I never know which way to go after the double L. Thank you.
Serena always seemed to do the trick. So.
She's incredible, great personality. We have her running the budget side, so we've separated that from operations. So she's in all of our budget meetings. We met this morning to finalize the operating side, so we're moving along okay. We have a finance manager vacancy where we are down to the final round of interviews, and we will complete the last interview tomorrow morning. So with any luck, we will get a job offer out on that and start getting some people onboarded. So the primary plan is to keep Serena with us through budget adoption, creation of the budget book. When that's done, to let her go back to retirement. Stephanie will be here until we hire the new finance director, and we're going to do that after the finance manager. So assuming the new finance manager is onboarded, everything goes well, we'll start to go out for a finance director using a recruiting firm and try and get that up as quick as we can. But that's probably a 6-month process if everything goes right. So we'll get to know Stephanie pretty well in the interim. So I think that's to the best of our knowledge how we plan to break it out. Of course, if we have the opportunity to keep Serena longer to provide assistance in other ways, we would, because she has a lot of historical knowledge of the organizations. So that's the plan. Happy to answer questions if you get them.
Did Serena go to work at the Hills?
No, talk about that stage of her life, but yes, she was employed up in the hills for a while. She did really well up there too. She was really well liked and retired from there. I think she ended up as admin services director up there, one up there as finance director, and received a promotion as well.
Sooner the better, but hire somebody you like.
Yeah.
And I guess it's so early, you don't know what the applicant pool even looks like. You haven't pulled the
Or
director.
we haven't went out yet. The pool for the pool for finance manager was pretty good. And as we compare it to previous recruitments, there was a point coming out of the pandemic where finance or planning, they could go anywhere they wanted at any time. It was hard to hire, but that thaw appears to be thawing now. So we had what we consider a deep and talented pool. We're down to the finalists, so hopefully we make the right choice.
Okay.
We'll miss you too.
Yeah, this will be my last meeting, I guess, here. I talked to Patrick this afternoon. It's a really great pleasure actually to work with all of you. And it's really, I can express like how great this commission is, very involved in city's finance. Not as seen as the city for before, just be honest. They're really helpful. I mean, be honest, it's really helpful because for us as finance director, we deal with a lot of things. We do operations, we deal with budget, we deal with audit. Investments is not in my purview. I mean, just in this case. So with all of you actually give me some advice and then give me some directions is very helpful. Thank you.
Good luck to you.
Good luck to you. Thank you.
You realize you started your job 2 weeks ago, so that you be here tonight, but you're still giving your time. And Gabe, clearly you have some charm or something, but to double thank you for giving more of your time when you're already working full time. Like,
Very classy exit.
The department actually goes success and I want to have a really great transition plan. So that's me and Gabe have another arrangement so help until like May 3rd because of the CIP budget. And I'm going to work with Stephen to have that and get to, might not get to the details of what you like, but we'll get towards that direction. Yeah, one step at a time, yeah.
Well, congratulations and good luck.
Thank you.
And if you need help interviewing, Gary does finance directors and police directors.
You guys lucked out.
Right. Anything else you need from the commission? Can we wrap her up? All right. Call the meeting closed and see everybody in May and.
Except me.
Except you.
Yeah, I'm leaving the city, so I'm not allowed to stay. And so that's my last thing. Mountain View, not enough rental available in Los Altos. I'm selling my house, I needed a rental place and I couldn't find what I wanted here. So I'm a neighbor, but I can't participate, so good luck with everything.
Are you going to go in there?
No, I'm just going to adjust to my new life. Yeah.